Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Market Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. So I've covered bank for more decades than I care to admit, and I don't know if I've ever seen a quarter like the current one being reported. Among all of the superlatives thrown around, this one from the August Wall Street Journal may have captured the quarter's performance for the largest banks best. Cartoonishly good. Granted, that description applied to some of the numbers, like JP Chase and Goldman Sachs both reporting 24% ROEs. Jeremy Barnum, CFO of JP Morgan, observed the market is clearly extremely risk-on and we're kind of takers of that. His boss, JP Morgan CEO Jamie Dimon, said it's getting close to as good as it gets. This week, our three things are: 1. AI debt issuance. Just how big is it? 2. Updating the Fed. Challenging conventional thinking is a good thing. And 3. Big bank credit color. What to worry about. All right, let's dig a bit deeper. AI debt issuance. So I guess a string of $25 billion bond deals will eventually get some attention. That seems to be the case with regard to the AI financing story, as both The Economist and the Wall Street Journal are out with stories covering this phenomena. The Economist's piece is titled, "AI has taken over the stock market. The bond market is next." The Journal's piece is, "The $250 billion onslaught of AI bonds is testing investors' limits." The issuance deluge is leaving a mark on the corporate bond market. What do we think about all this? Well, here's how we're responding to oft-asked questions. Is the issuance affecting the Treasury market? The answer, no. The U.S. Treasury market is roughly $31 trillion in size. Total debt issued by the five hyperscalers plus NVIDIA plus SpaceX is approximately $0.57 trillion, or less than 2% of outstanding U.S. Treasury debt. For those worried about index concentration, even if we assume 90% of big tech issuance is included in the Bloomberg U.S. Ag Index, while only 54% of treasuries are, by the way, that figure comes from JP Morgan Asset Management as of March 31st, big tech issuance represents just 3.1% of that index. And it goes without saying that there are many other factors that drive supply and demand for U.S. treasuries: funding need, haven status, investor mandate, hedging needs, to name but a few. And then there is the sheer breadth and depth of the addressable investor market. Big tech issuance today and tomorrow is not moving this needle. What about the corporate market? Well, assuming again 90% of big tech issuance is included in Bloomberg's IG Corporate Index, the sector represents about 6.5% of that index. The index typically has individual names representing upwards of 2% of the total. For example, Amazon currently has $121 billion of the Bloomberg IG Corporate Index, equal to about 1.5% of the total. Big tech will become a meaningful concentration in the IG market, but it likely won't get anywhere near the financial institutions concentration, which is upwards of 1/3. Now, what about concentration limits on individual big tech names? Well, they're going to be set high by investors, and there will be limits to just how much an investor will take of a name. The stronger the rating, internal and/or external, of course, generally the greater the limit. In terms of capacity, we believe investors are happy to diversify down their large bank exposure, which is the single biggest concentration in the IG market, with new, highly rated, widely followed, and bought industrial names. Is the issuance crowding out other borrowers? So on the margin, the very edge of the margin, an issuer may have to pay up a fraction of a point to get a deal done in a calendar where investors continue to have to make room for big tech. But for all intents and purposes, we do not see this wave of issuance crowding out borrowers. All right, on to our second thing, updating the Fed. So the central bank is data dependent. 1 month doesn't make a trend. Monetary policy cannot address supply shocks. Policy shifts are a committee decision. You've heard these adages used to describe the Fed and its reaction function over and over again. But there's a new chair in town. Safe to say, all of the things we've come to accept about how the Fed operates are not in flux, but we get a sense that some change is afoot. Take the comment by Fed Governor Chris Waller this week. Sternly staring at inflation until it melts before our withering gaze is not an option. Given that inflation has been above target now for 5 years, this seems like finally a call to arms. In fact, in his speech this week, Governor Waller spent a lot of time talking about past policy errors and how to avoid them. We need to avoid making the mistake of fighting the last war and reacting too soon to tighten inflation, merely because we waited too long the last time, he said. But we also must avoid repeating the same mistake we made in 2021 and 2022 by waiting too long to respond. In any event, we believe there's a new sense of urgency about the place and a proclivity to challenge conventional thinking. Investors, of course, have focused on the withering gaze comment as a sign that this FOMC thought leader has taken Chair Warsh's declaration that the committee will deliver price stability to heart. The chair reiterated that this week, testifying in front of Congress. The members of our committee have no tolerance for persistently elevated inflation. Now, what constitutes elevated is debatable, but it appears to us that finding reasons to defend above target inflation has just gotten tougher. Now, that's not to say that we see rate hikes in our near future. We don't. We're very much in the camp that the Fed will be on hold through the end of the year. And that means the chair has to come up with persuasive arguments that the best course of action is to not change, to stay the course. That's where the chair's newly announced task forces come in. By targeting September at the earliest as the point in time when task force findings will be disseminated, the chair has theoretically bought time to see one, if inflation would indeed come down, and two, if employment remained at or near maximum levels. Waiting to act also allows for task force studies of inflation and the labor market to incorporate new data sources and points of emphasis, something that many have hoped for some time. I have to admit that I've grown tired of hearing about a data source being the quote gold standard, unquote, when in fact developments in data collection and new sources of data suggested anything but. Here's another consideration. Rates are close to neutral. This is a great time to get the house updated. All right, on to our third thing, big bank credit color. So we always check in on the banks for an up-to-date view of credit from the largest lenders, JP Morgan Chase, Bank of America, Wells Fargo, and Citigroup. Now to start with, loan loss reserves as a percentage of loans fell year over year at all four banks. Now a cynic might say banks are padding earnings by under-reserving. The fact of the matter is the banks have to justify the risk in order to shield income from taxes via reserving. That's hard to do when problem loans in consumer and commercial loan portfolios are very low and declining, which is the case today. JP Morgan said consumers and small businesses continue to show resilience despite elevated gas prices and inflation. Management guided the full-year loss rate on credit cards to a low 3.2%, an improvement over the prior quarter's already low guidance of 3.4%. On the commercial side of things, management highlighted aggressive credit underwriting in data centers, pointing to risks centered on power supply and tenants. Management commented, "We saw some deals where we were like, we're not doing that." Overall, management sees mild deterioration in underwriting standards. At B of A, management describes the economic backdrop as very constructive and more durable than expected. Inflation and tighter monetary policy remain key risks. Credit quality remains stable with improvement noted in commercial real estate. Management described credit quality as high, adding that the issues of the moment, whether it's real estate 4 or 5 years ago, or whether it was private capital lending, just aren't surfacing the way people thought they would. At Wells Fargo, management noted that consumer and commercial credit quality remains strong across all portfolios. On the consumer side, delinquency trends are better than we modeled most months, really every month that we've seen now for all year across each of the portfolios. We're not seeing any cohorts of clients deteriorate, whether you break it by FICO or other ways to look at higher or lower income levels. Management added, the strong employment picture and good wage growth counteract some of the inflationary issues that we've had. And so overall, you're seeing really good performance on the consumer side. While businesses are cautious, according to the bank, balance sheets and cash flows remain strong, resulting in strong credit performance. There's no systemic issues that we're seeing come through the portfolio. There's always individual idiosyncratic issues you might see with an individual borrower, but overall, we're seeing really good credit performance. Management acknowledged that credit risk tolerance on the wholesale side, seen in the deployment of significant amounts of capital, not just from banks, but also from non banks, makes it a very, very different story from what is happening on the consumer lending side of things. In particular, some of the lending on data centers and on strategic transactions were singled out as being particularly aggressively underwritten. But let's not bury the lead. Overall, data and anecdotes from the largest lenders paint a rather benign picture of credit. So there you have it. Three things in credit. One, AI debt issuance. Across a global investor base, supply is manageable. And two, updating the Fed. We look forward to the results and recommendations of the task forces. And three, big bank credit color. Banks have de-risked and it continues to define performance. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. We'll see you next week.